Understanding Issued Shares, a comprehensive guide. In the world of corporate finance, understanding the nuances between different types of shares is crucial for investors, company management, and anyone interested in the dynamics of stock markets. Among the key types of shares are authorized shares, issued shares, outstanding shares, and treasury shares. This article focuses on issued shares, their implications for ownership and capital structure, and how they relate to other types of shares. What are issued shares? Issued shares are a portion of authorized shares that have been sold and are held by shareholders. These can include stock sold to the public as well as shares allocated to company insiders, generally as part of their compensation packages. The details of issued shares are typically included in a company's annual report, providing insights into the company's capital structure. Differentiating between types of shares. 1. Authorized shares. This term refers to the total number of shares a company is legally allowed to issue as stated in its corporate charter. This number can only be changed with the approval of the board of directors. 2. Issued shares. Issued shares include all shares that have ever been sold to investors. This includes shares held by insiders and institutional investors, as well as those held as treasury shares, which are bought back by the company. 3. Outstanding shares. This category includes shares that are currently held by investors in the marketplace, excluding treasury shares. Essentially, outstanding shares are calculated by taking the total number of issued shares and subtracting treasury shares. 4. Treasury shares. These are shares that were once part of the outstanding shares but were repurchased by the company. These shares can be reissued or cancelled, but they do not confer voting rights or dividends while held by the company. Understanding the distinctions among these categories can provide insights not only into shareholder allocation but also into a company's strategic financial planning. The importance of issued shares. Financial reporting and valuation. The number of issued shares significantly impacts a company's financial statements and valuation metrics. For instance, a firm's market capitalization is calculated by multiplying the total number of outstanding shares by the current stock price. Similarly, earnings per share (EPS) is derived from dividing net income by the number of outstanding shares. Thus, both of these key financial figures are directly tied to the management of issued shares. Ownership and control. Ownership in a corporation is typically determined by examining who holds the issued shares. The implications of issued shares on ownership structure are profound, particularly as new shares are issued or repurchased. For instance, in a startup scenario where a company has issued 10 million shares from an authorized pool of 20 million, the original owner may control over 100% of the corporation if no other investors are involved. However, as the company raises additional capital by issuing more shares, the ownership percentage of existing shareholders may be diluted unless certain measures are taken. Understanding dilution and strategic issuance. When companies opt to issue additional shares, existing shareholders may find their ownership diluted. This dilution occurs when more shares are issued beyond the initial allocation, which can reduce the percentage of ownership and affect voting power. To mitigate this effect, companies often strategize around their share issuance, such as through a rights offering, where existing shareholders are given the opportunity to purchase additional shares before they are offered to the general public. To manage potential dilution while incentivizing performance, boards may use tools like stock options for employees or convertible securities that may dilute existing shares at a future date. Hence, the concept of a fully diluted share count emerges, representing all possible shares that could be outstanding if all options and convertible securities were exercised. Considerations for companies issuing shares. Issuing shares can serve as a means for companies to raise capital while avoiding debt. However, there are potential drawbacks, including regulatory scrutiny. Publicly traded companies face rigorous regulations and disclosure requirements, complicating their operational and reporting practices. Market perception. If a company frequently issues new shares, it may signal financial instability or poor performance to the market, potentially damaging long-term investor trust. Shareholder discontent. Investors may view additional share issuances negatively, especially if they believe their stakes are being diluted without sufficient justification or benefit. Conclusion. In summary, issued shares are a crucial component of a company's equity structure, influencing everything from capital raising to ownership dynamics. Whether a company is growing, repurchasing shares, or issuing more stock, the decisions about shares have far-reaching implications for its valuation, investor relationships, and strategic direction. Understanding the interplay between issued shares, outstanding shares, treasury shares, and authorized shares is vital for anyone looking to grasp the complexities of corporate finance and stock market behavior. By remaining informed about share issuance practices and their implications, individual and institutional investors can better navigate their investments and the overall market landscape.